Hey guys, it is Markets with May, and as always, past performance is not indicative of future returns. Today is March the 10th, Thursday. Crazy day in the markets as per usual. Oh man, it's just not going to let up, this volatility and insanity. I'm going to start sharing my screen and let's get into it a little bit. I'm going to show you economic news this week. We had talked about the fact that you should be very careful laying in your shorts, or I'm sorry, laying in any kind of long exposure, because CPI can be a real doozy. Inflation, we knew was going to come in very high. It definitely came in high, but I want to go through the components because it was a little bit interesting there. This is my screen today. And we are going to talk about Amazon because I know you guys care, and it's one of the few things that's green holding up the entire index. Google, as you guys know, I am a fan of. It's going to be volatile, but honestly, among the FANGs, not honestly, you can go look this up. There's no need for me to be honest or dishonest. But one can easily see that Google is by far the cheapest of the FANG stocks. And, you got to be careful in this market. So if you are going to put on exposure, in using options instead of just buying it outright, back it up a little bit, and stay off of the inside of that option smile, if you will. But it's not down nearly as much as the other indices, and I think that's for good reason. The other area that we're seeing a lot of strength today is energy, and that's really interesting because it is, despite the fact that I think the market is trying to short energy out of some kind of belief that that is going to take money away from Putin, or however you want to think about it. I don't know how to think about whether or not that's true. It's not sustainable. I will say that, if that's the only reason that oil is down. I suppose some people also think that the run-up was extreme. We're going to go through that. Again, our thesis is real. Our original thesis, which the Russia-Ukrainian conflict has absolutely escalated, is that the back end of the curve being much lower than makes any sense for investment was originally what was causing the failure to invest further within oil and nat gas. And that's actually, unfortunately, because of the weakness in the front end of the curve, backed off quite a bit. Now, we did see this earlier in the week, closing in on 90, but not this far back. It was really just in 2022. So it becomes a very strange time right now in the world of oil and gas. And it becomes strange. The next expiration you'll see is April for delivery. And then we have, and then May, June. So each month in the spring. And what that's in preparation for is the summer months. So you get a little bit of respite, provided we don't have an extremely cold spring, which happens from time to time. Now, remember that the oil market does connect to the agricultural market through a number of different factors, not the least of which is corn. And these prices still represent a great deal of elevation. And as we've been talking about, and I really want to kind of accentuate it because I'm watching how things play out, it's not just Russia and oil that we should be concerned, confused, or monitoring from the financial markets perspective. Okay, remember this. There's not political opinions in this. I hope people don't take me the wrong way. I'm really just trying to show you what I'm seeing so that you can make investment decisions for yourself relative to what your feelings are and what your risk tolerances are, et cetera. But we also watch this very closely because the Ukraine is really a breadbasket of the world. And the longer this goes on, the later this planting season happens for spring wheat. It also is for other things that the very fertile land of the Ukraine produces for continental Europe, primarily, but also other areas, that border around them. So it's not just oil and gas that we're concerned about. It's also spring wheat and then other harvest items, which would then put pressure on the entirety of the ag complex, which already has significant pressure here, and with oil where it's at. It was even significant pressure with oil even in the last quarter. We saw Archer Daniel Midland very clearly discuss the fact that ethanol prices were such that it was incredibly profitable for them on the foreign side, and as a result, they expected the price of all the grain complex to be quite profitable this year for them. So we are watching that. I watched an incredible old mentor of mine who was speaking yesterday, and I will post it in the Discord for our members that are paid subscribers. But really, the thing that I would highlight there is the idea that it's not just that we're worried that the harvest will now be planted late, but some experts are talking about the fact that the harvest may just not get planted if this extends for much longer. So then really there is no spring wheat. And also, you know, if people are bombing your country, it's not like you're putting fertilizer down in the ground correctly. You know, luckily global demand is so significant that the Ukraine specific demand probably isn't going to move the needle quite so much, if you will. And the fertilizer stocks are just so massively undervalued. So that's nothing one way or the other. But I would also mention that, you know, it's just, okay, the headlines are, you know, I got to get to CPI. Let me hit pause on that, but I'll get back to that. Let's go to CPI really quick, because CPI was what originally, I think, drove the markets down more than anything. And I was really surprised that anyone would think that this number would come out anything other than what it did. But I want to show you the one quizzical component of this. 8% it's just high, right? And we see an escalation from January to February, and everybody's staring at this knowing that that number is going to be even higher because energy prices were much higher in the first part. I mean, they've already started the month out pretty aggressively, and gas prices, et cetera. And now we're going to be shipping a lot overseas, and it does take some time for that capacity to come on. We really need it to come on if this doesn't get resolved in a way that is okay for all populations across the world. We really needed to come on before the summer, because we might get lucky and have a very mild spring. But if we don't have these reserves back and we don't have production back up to meet both the shortages that existed before the Ukraine conflict, but also the exacerbated production that is most likely happening in that region, I'm going to show that to you. Then we're going to have a problem this summer. And if this summer is hot, oh my goodness, this could be a really big problem for pretty much everybody. This isn't just an America problem, it's a global problem if it continues. Now, I really want to show you this one thing here that was on CPI, because the other stuff is bad, but this one is really quizzical. And that is that the electricity number for February is actually down somehow month over month. Okay, February was not colder. I mean, it was a little bit colder in fairness than January. So, you know, but my suspicion is this doesn't come from us having mild temperatures across the United States. My suspicion is that relative to last year, this comes from the use of coal. That's what I think happened here. Now, some people will probably put out headlines that I am just full of it. Maybe not. I don't know, but we are definitely seeing coal usage in the United States pick up after having the weakness from last year due to low energy prices. I do want to just take a half a beat to also just mention a few other items. New vehicles, used vehicles, that is up. Used vehicle prices started to fall a little bit. And we got a little bit of a buffer on new vehicles. So, you know, that's kind of the flippy there that happens a bit. And then food up a lot. I mean, this is a big number for food, and it's going to really affect the lower end of payment here in the United States. So that is incredibly unfortunate, and something that I really think is going to be intriguing to see how the Fed deals with that as we go forward. Now, this is something that I just also wanted to highlight. I'm going to be doing a lot more to try to see if there are better ways to demonstrate the impact of renewables and potentially some miscalculations that I continuously seem to see and have, and they're not accurate, right? We know that nuclear by far is the most energy producing and least, provided nothing crazy happens, the least polluting of all energy sources. This is not me, this is scientists, this is other folks pretty much everywhere saying the same thing. But I'm going to get slides that more clearly show this. This is coal, this is nat gas, right? So this is the mix of energy usage in the United States is primarily nat gas, and we don't have enough of it. And now it's not that we don't have enough of it, the world doesn't have enough of it. I want to kind of show this because I have had some pushback, and I love pushback because it does make me a better researcher and better investor. This is from the National Renewable Energy Laboratory. I have posted this in the Discord for folks to review for themselves so they can make their own judgments on this. But you can see here that a lot of the assumptions of the benefits of renewable were based on a nat gas price that was going down. And their assumption was that the demand coming from electricity would naturally drive the price of nat gas down. And in fact, they write almost as if it's like a fun thing for them that the nat gas industry will be absorbing all of the impact of the transition to renewables. And so, you know, that is what it is. So if we're confused that renewables had some kind of antagonism for nat gas, it's really clear as day in some of these things, you know, and I think that's really unfortunate because nat gas does pollute significantly less than coal. And even if we were, you know, trying ourselves as the United States to move towards renewable away from nat gas, we could have just become a nat gas exporter to allow the rest of the world to transition off their coal dependency. China, Latin America, we can keep naming countries all day long that use coal as their primary mix. So I think it's really unfortunate how this is played out, but I'm going to find more papers that would have gone to the White House and to various people to demonstrate this. You can see very clearly from this paragraph their assumption in modeling as relates to nat gas. The effects, I'll read it for you in case it's too small on your screen. The effects of natural gas price changes outside of the electric sector, however, are not included within the renewables estimates model, is what this REE reads is. To estimate these consumer natural gas bill savings, we apply the regional nat gas price changes estimated by Reeds to the EIA estimates of future non-electric sector regional gas demand basically are not included in the model. So they weren't anticipating any kind of global concept of nat gas supply and demand dynamics as they were doing these papers. I think that was a huge assumption miss. I don't think that's a small assumption miss. And the other thing that I think is a big assumption miss is, you know, I'll have to really look into this model that the IEA is using, but my suspicion is this IEA model was really being modified and adjusted for a much shorter time period than the 2050 time period that these renewable models were being timed to. This is an incredibly long period to believe that you can guess the price of nat gas, just for the record. So I'll try to find more papers and really dig into it, but it's highly possible, like I said, that this administration's group of brainiacs maybe underestimated or misconsidered how precisely the commodity curve relates to investment in energy. Okay, so with that, I want to go through just a touch of the geopolitics before we get into everybody's favorite Amazon right now, I'm sure. You know, one of the things that I really want to highlight for you, there is this tracking of sanctions against Russia. And just in case it's something that I think everybody should watch this, there are two kind of things that are a little bit concerning from a markets volatility perspective. Okay, let's just be really clear. Again, this is about trying to understand how much volatility the market ought to price in, should price in, and also thinking about potential future risks, headline risks, as well as real risks that will impact all of the markets. That's what this is about, guys, okay? And then when we look at this, realize that some of the sanctions are towards Russia, and some are also starting to orient towards Belarus, okay? I'm not sure where I found it in here. We're just gonna have to, I'll look for it later. I apologize for not having it at the tip of my fingers, but there are some, oh, here we go. EU hits Russia and Belarus with more sanctions set to snub Ukraine on SWIFT membership. Okay, I don't know that people have really been talking about Belarus and what they're experiencing and why it is maybe that they are waving the way that they are as a nation in this particular conflict. I do think it's a little bit important to understand what Belarus means to the global economy. I know a lot of times with these nations that are outside the United States, it's very hard to just be immediately knowledgeable about them. So I do want to just show you, my goodness. Okay, I do want to just show you, this is what Belarus exports, and they import about the same as they export. Oh my goodness, do I not have the slide? Here, hold on one second. Sorry, I lost my place. Okay, this is what Belarus imports. And you'll notice that their major import partner is Russia, 57.2%, okay? And they import mostly this crude oil, right? And then we've got a bunch of different equipment and then iron. Okay, and that iron is probably coming from Ukraine, which we know is a huge producer of all things iron, and that's going to impact and disrupt whatever's going on right now. Okay, what I think a lot of people might not realize that is very important is what Belarus exports. Okay, they are taking essentially the oil that they're getting from Russia and refining it. So they are a big time refiner of oil. Additionally, this one right here, potassic fertilizers, we have mentioned before because they have not been exporting this for various reasons. But you know, this has been part of the reason why we are such big fans of Mosaic as well. When that announcement came out, we were already extremely bullish, given the Chinese weren't going to be exporting either. When this announcement, Belarus, one of the larger producers, we were like, I think Mosaic makes sense. Also, Mosaic doesn't have like nitrogen, some of that nat gas exposure where you got to do special math, but you know, I'll admit it, I'm long nitrogen as well right now through CF Industries. The other things though is this right here, which is they are also a net food exporter to you know, the rest of Europe. So this is also not so great. If you're trying to think about supply and demand dynamics, I want you to kind of see that portion of it. So be aware of that. Again, the Ukraine is really about being the breadbasket of Europe, or one of the great breadbaskets of Europe. That's really not great. And one of the reasons I show you this is that, you know, there's a lot of posturing and there's a lot of news flow and there's all these different things. How will this play out? What ways will it result, and what will be the after effects? You know, I was listening around to various folks on the that are, I guess they're finfluencers or whatever you call it, and a lot of them have been spinning this whole thing as it will be positive for Europe after the war is over, because people want to reinvest in Europe. Now, I can see people want to reinvest and help out Ukraine in a big way, because there's a lot of damage that's been done. And for this country to kind of get back on its feet and be that breadbasket and be this wonderful resource to the world, they're going to need some help for sure. I think that, okay, so everybody's assuming that Putin will just back off in its entirety and do nothing there subsequently. There is also the following possibility, and that possibility would be that Putin decides that whatever happens, that he's going to make some money back, so to speak. And the way that he would do it so easily is because of his role. Let me see if I can find it down here. Because of what it is that Russia exports. I mean, just take a look, right? It's these are all things that are supply constrained right now. Okay, so this is why, again, I think the whole Russia-Ukraine conflict has escalated our thesis throughout, because an accentuated price of oil and gas probably leads to coal prices rising. Coal isn't in the areas that I cover, but if you are long coal, just kind of keep that in mind, because renewables are not going to be able to compensate for the period of time that it takes to really bring on the volume that we're going to need for the disruptions, plus the shortage in supply that we already had. So kind of keep these things in mind. Additionally, again, Russia exports out a lot of metal, and overall, then you've got wheat and the entire grain complex, and all of these, you know, just to show it more clearly here, all of these would be ways that, I mean, look, you know, I don't know the inner workings of a despot, for lack of a better way to say it, but it wouldn't take, I'm sure there's someone that's thinking about it this way. So I would just kind of keep that in mind for those people that are massively bullish all the time, Europe and how awesome this is going to be, and any kind of resolution that occurs, how excited they are for the prospects of Europe subsequently because of the end of this issue that's looming. Realize that there's a second issue that's going to come right behind it, and that is inflation. And that is the nature of this particular inflation is not going to be fixed with monetary or even fiscal policy very quickly or very easily. Let me say it that way. Now, I do want to mention this too, because I've been hearing this a lot, and unfortunately, this affects China, and also, unfortunately, it's probably escalating some of the things that Chinese Americans are experiencing here. There's been a little bit of this, like, China's going to come to war. We're just going to, and I really think that's very strange, because every release that Xi Jinping has given has been to try to, like, calm it down. I mean, he's gotten way calmer as far as, like, the way that he's talking about this conflict. And it's not, I think, for the reasons that everybody's trying to spin. But I want to just introduce you to this concept, which is typically taught in political science. Now, there are more complex versions of this. So if you're a political science nerd, you're going to know exactly what I mean and be like, that's so basic. That's so 1990 or something like that. But, rather than teach the more extensive models, let's just keep it simple with 4 variables. And that is, these are the 4 ways that countries exhibit power: diplomatic, information, military, and economics. Now, historically, America's been primarily using the M1. And many have argued that we're using the economic one, and that has been very, very effective in scaring China. And these are the articles that I'm looking at, many, many more, because people are forwarding them to me all the time. Here's the hidden blessing of China and Russia's hostility, meaning that because of that, everybody hates China and Russia. Okay, let's just say that is the propaganda that's happening. China asked Russia to delay Ukraine war until after the Olympics, is being spun as if China knew something, versus China was just like, all right, could you just chill out, because we're about to do this big event. Maybe you can give some time to diplomacy, what have you. And then Xi, unsettled by Ukraine, didn't expect Russian difficulties. Okay, I just want you to understand that what has just happened in the way of diplomacy and economics is this, essentially, these global sanctions. And on the near term, I really hope it puts a very quick ending to this conflict, because really no one in the Ukraine should suffer like this. And none of this is really beneficial to a world that really does need to produce very specific things so that we can tamp down this inflation hand in hand globally. Here's the thing, though, that is a little bit concerning about this particular spin. And that is that one of the things that a lot of folks have talked about is the fact that the sanctions related to SWIFT have just basically pushed Russia and other countries that might have sympathy onto China's version of SWIFT, which, by the way, is a little bit more technologically advanced. So SWIFT is one of the oldest systems in banking that you will ever see. And part of the reason that you can't exchange, if you were to remove money from a brokerage account, you might have to wait 7 days. I think I waited 1 month before, within the last year or so, to move a brokerage account from one broker to another. That's all because of SWIFT. That's how archaic that architecture is. China's architecture has been built within the last 20 years. It's not nearly as archaic. So there were already reasons why some countries were moving on to that banking. So there's that. Additionally, it's probably bullish for Bitcoin, although central bank digital currency in China is a real thing and they do not accept Bitcoin. So realize that there's some implications there as well. But if anything, if someone was looking at this from a non-US perspective or a non-Western perspective, my suspicion is that this whole mess that we're seeing would probably drive not just China, but other nations into more of this bipolar phase and separation phase. And I personally don't like that for the global markets. So it's just something to very much so monitor. I do want to remind everyone that it's a bit of a dangerous game, because this is the balance of payments for the United States of America. And a couple of episodes ago, I talked about the fact that China's, we continue to increase our imports from China. And we do that because we do have inflation, and they are a cheap provider of a lot of the things that are on CPI. Let's go through them again, just to make it clear. Sorry about that. All of this down here, like auto parts, a lot of that comes from China to try to decrease costs. Apparel, all of that comes from, well, it doesn't what it actually comes from Vietnam and then goes to China and then comes over here is really what happens, but some of it comes actually as well directly from China. And then, then we got the service industry. We don't really do any food with them whatsoever. But it's a really not great predicament, let's say it that way, to have this kind of conflict with our largest trading partner. The thing that I said in the other show that's always been unfortunate and that I would love to see the Americas do is that we have had a bit of a weird frenemy situation as well with Latin America. Latin America and Central America, as you can see, we have a positive balance of payments with them, and it's getting increasingly positive. So you know, there are some things here to watch. Now, I also want you to notice that Germany, Italy, and France, all of which I just mentioned, should be experiencing some pretty aggressive inflation. You know, they're also places from which we have a net negative balance of payments, meaning we import in more than we export. So those goods and services might also be coming up. And now the last thing I kind of wanted to mention along those lines that could be a little bit problematic is what we've been kind of reviewing or hypothesizing. You know, I don't have access to all things. I'm just, you know, kind of chilling here doing this work. Oh my goodness, where'd my slides go? Okay. Let me just try to look for them real quick. Belt and Road Initiative. We have hypothesized that this 2019 chart no longer looks like this, with China increasing its goods and services through to Europe. And the reason we think that is because this IMF report shows, which shows where interest rates are rising, where inflation is across the globe. So this is inflation rate colorized. Light green is 0 to 3% inflation. As you can see, that hasn't been the experience of America, unfortunately, but that has been the experience, largely speaking, of Europe. And I believe and we can look at China and see, you know, given the way that Europe lays out, it is highly possible that Asia has been helping them, and specifically China, manage this inflation. So this is very concerning in general, as I think about what would be the nature of the volatility component of the U.S. markets, let alone all markets. I continue also to be concerned for any kinds of U.S. U.S. listed Chinese stocks, because if we are really entering this world of separation, and if you're Xi Jinping looking at this already, you know, the Chinese markets had already been very closed off because of the, you know, China has never been confused about the use of economics as a way of enforcing power, ever. I mean, that is the whole reason why there's an A share, B share class for foreign investors and domestic investors in China. So if you're looking at this and you are still long Chinese stocks, I would just make sure to hedge very carefully. You can hit me on the back channel. We could talk about it. But I think if you're thinking, oh, I want to go in on all the Chinese stocks, they're so undervalued, you know, I guess it depends on your time horizon, but I would highly recommend that you be very, very prudent about both your timing and your entry points. Now, one of the net winners, and unfortunately I had a backup slide to this that I forgot to put in here, is Brazil. Brazil really is one of the few countries that produces, as the major part of its economy, literally everything that that seems to benefit on the commodity side. I mean, they are such a material-rich country that it's not even funny. And then, you know, if you look at this between materials, basic materials, energy, consumer staples, you know, they should do quite well during this period of time. Additionally, Brazil has good relations with all of the countries that are currently at conflict. So just keep that in mind. If you were looking for more of a global macro exposure, it might be nice to have a few calls on this to the extent that they're affordable. If you are going to do this, please put it farther back, especially if you put it in months that maybe correspond with a little bit more clarity on how the crops are going to go. Now, they are in the southern hemisphere, so, you know, but if you look at the map, they have a bunch that's right on the equator as well. So just kind of give it a little time is what I do, and just go a little farther back on Brazil. But just have a note at that. Now, let's talk about Amazon. Amazon announced a 20-for-1 stock split and $10 billion share buyback. To me, I think this is an announcement attempt to support the stock so they don't have to actually come in and buy it back. Now, just to remember, just because you announce a share buyback doesn't mean that you have to do anything about it for a while. And 20-for-1 stock split, while it does make it easier for people to buy your stock, it also makes it easier for people to short your stock. Okay, so realize that. Additionally, if someone wanted to pair their positioning down like you're an employee, you could pare it down in a way that is a little bit easier for an algorithm to hide if you wished to. So there is that benefit just from a trading perspective. It's a little bit complicated, and I don't think that's why they're doing it. I think they're doing it because the stock is not performing well and may not be performing well for a bit of time. Because I don't buy that they're going to do this $10 billion share buyback, because it would be a very poor use of capital given what they cash flowed this last quarter. And it would be very strange for a CEO to decide to use capital that way. Again, we're not long-term bears of Amazon. Amazon just trades incredibly expensively relative to Google. And even though some folks are willing to give a 50 multiple, is what is implied, to the cloud business, Google has one too, and they're not getting a 50 multiple, they're getting a 23 multiple. So it's a little strange that Amazon should deserve such an extreme multiple, but none of the other large cap guys should deserve that. So realize that, but let it settle as per usual, and then find a spot therein. And then, as always, be careful once we get closer to Amazon's earnings season. I will come back to that one in I'll end it in just a half a beat, but I do want to go ahead and take a little bit of victory lap on this one, Clorox. And the reason it's not so much that, oh yeah, that's great, I totally nailed this one. That's not really the point. The point is that she is a wonderful exec, and she made a very specific bet, and she's not the only one that made this bet, by the way. She made a bet that inflation was transitory. A lot of us thought it was, self-included. So, and that she would kind of manage her inventory for that possibility. And as a result, organic sales decline came in. That's something I think the street might have had some thought process around. We bought an awful lot of cleaning supplies as soon as COVID hit, and then you got to kind of work through those cleaning supplies. But I think what was miscalculated even more than this massive inflation we've had is the massive movement south, driving up the price of chlorine because of its use within pools and other type of recreational things of that nature. The issue with this is that it trades at 33 times. Now it's trading a little bit less than that because of today's weakness. But look, it's not growing anything remotely like Google, so it really shouldn't trade at this crazy multiple, especially since EBS was adjusted downwards, not upwards, and there was still going to be some work to reacquire that inventory that you didn't have, especially in this particular environment. So realize that. There's another stock I haven't prepared a slide for yet, but that kind of looks a little bit like that, and that would be Kellogg. Kellogg, unfortunately, had a whole series of unfortunate events, not the least of which was labor union disputes, and they're going to have to restock inventory. They had some of that problem come out in this last previous quarter, but I'm not convinced with what's going on in the grain complex that they're going to have a good time restocking that inventory. So Kellogg, if you're short that, I have some exposure on the short side of this. I wouldn't necessarily take huge swings at it because people love to go to staples. So both this and Kellogg for safety. I just think these aren't the places to go for safety. And with that, I will pause for just a second or a bit longer and see if there are questions. Any questions?
Hey, May.
Hey, how you doing?
It looks like SEC is starting the delisting process, which takes 3 years, of some ADR stocks, Chinese stocks. So
yeah, I wasn't confused.
Do you think that could be political, or I don't 100%. Get it?
I think it's 100% political, because I think the way that this world is going right now is really it's upsetting to me, because I think that we had such a shot as a global community at world peace, and we couldn't possibly have taken a bigger step back in the last 3 weeks. So it's very sad for me to see, having grown up in a time of peace. And I would love to see some leadership and de-escalation of this, but I just haven't seen any evidence that that's going to be the case ever since the initial firing was set off. And I was watching the events unfold. I think one person texted me and I was like, yeah, hopefully it'll be over quickly. And then I immediately, after the first day, was like, oh boy, everybody's posturing in the worst possible way against each other. This is really scary to me.
Yeah, cool. Okay, so originally Chinese wanted stocks listed in Hong Kong, right?
Well, in general, and this is kind of independent of Russia, anything like that. China's ambitions are really to become a premier, to bring it back to where it used to be. And from China's point of view, they were world power leader, what have you. Interestingly, I just published on my other channel, Diary of Speed Reader, in conjunction with this, and I'll be posting more financial books. But Ray Dalio's amazing book, The World Changing Order, even if I don't agree with everything in it, he talks extensively about this idea. And that is that China, for most of the centuries, was actually probably one of the premier, first world countries, like, so if you go 5,000 years back and you look at where China was year for year, century for century, they have a certain feeling about things. Their ambition is crazy, and it's definitely something that is to be discussed. I don't know that right now it's the most important thing, but one of the definite things that they were absolutely trying to do was figure out long-term how to become the premier market. In other words, right now, everybody wants to list in America, and they see that just as something to take market share from. And so that was what this Hong Kong listing thing was all about. Now, I think, and that's what scares me so much, is the way that we've conducted ourselves. Come on in. The way that we've conducted ourselves in the last few weeks as a world. My bigger concern is that China goes back into isolationists and just pulls all these companies back into the Chinese system so that they can not be beholden to the E portion of influence in that DIME acronym that I gave you. And that would be very bad for all folks involved. It would be definitely bad for global economic interconnectivity and for anyone that's doing business in China. The private equity markets probably will not be impacted by this because the private equity market manipulation goes a little bit of a different way. But the public markets, anyone publicly listed might have this potential risk, right? Remember, I'm an options trader, so I care about volatility.
Right, but I mean, you have such a huge supply of venture capital here in the U.S.
It turns out. Oh yeah, let me show you this real quick. It turns out that is true. Something that often goes missed is this one thing. Hold on, let me see. Do I share my screen again? This is so weird. I'm always so bad at this. I tell you, these new technologies, every day I got to learn a new skill. Like, hold on one second, guys. Sorry about that. Okay. This is something that I think, oh my goodness, it's not going to be here, is it? Something that happened in 2021. Oh, here we go. China overtook the US in the national net worth spot. So, and in fairness, this is paper value because a lot of this came from real estate. We all know what's happened to the real estate market, but you can see this was published at the end of the year. So, there's been declines since December 19th. I'll give you complete credit for that. But a lot of times we pretend like there's no money in China, that China doesn't have its own venture capital funds. Well, that's simply not true. I mean, is it equivalent to the US funds? Difficult to say because it's really hard to get data to give you a true pari passu. I'm working on that, guys, though. I'm telling you, I'm working on trying to find a source that can give me a little bit more information. But it is a real misnomer that folks might have that a country like China doesn't have venture capital within its borders of significant size.
Cool, thank you.
Any other questions?
So I have a question, May. What do you think is happening with energy now? Is it just consolidating, or you think there's still more?
Oh yeah,
upside?
you know what? I do think it's consolidating. Look, energy. It's really interesting, and either you really have two sets of people, and only one can be right. It's so binary right now. Either there is a supply issue or there isn't. Now, all of the energy executives and a lot of the folks that I respect some of the most within this marketplace are saying we have underinvested massively within the energy complex. Nat gas, oil, coal might be the one thing you could easily get access to right now because everybody's trying to move off of it. And like I said, as much as we all love the idea of Germany potentially using nuclear because it is environmentally safe, and there's other things there. Look, I'm not going to try to get into the complexities of the politics there, but nuclear takes 5 years to put on, so at a minimum, now existing plants, you might be able to get up and running a little differently, but there's not either there's an energy shortage or there's not. The only thing that you have that might take a little time to prove it out one way or the other and see who's right is you've got spring. And if we have a nice, wonderful, beautiful spring, then it won't be any kind of problem. If we have crazy temperatures this spring, either it gets very cold, it snowed before here in New York City in May, in the month of May. Or if we have a very, very hot spring where we all move to air conditioners, then it will be very quickly demonstrated which people are right and which people are wrong. So consolidation is probably happening because there's a little bit of like, okay, what's actually going on here happening as well. I will say, and we have been very bullish, the oil and nat gas stocks for this reason, that oil and nat gas stocks are not pricing in anything close to what oil and nat gas are currently trading at.
All right, so yeah, I'm looking at a chart for Devon. And one of the things I noticed is from January 25th through, it looks like February 28th, Devon traded between $50.56 and $56. I mean, it just sort of, it was moving to the upside, but barely. And now it's trading in a range between 56 and 62. So it just, it's like it's on a shelf. And it just keeps moving up incrementally, and then it goes sideways, it moves up, it goes sideways, moves up, and it goes sideways. So I'm expecting that that's going to just continue to happen over time.
Sideways and up, sideways and up. Yeah.
Yeah.
I mean, we were talking about that. I think there's a few different names that directionally. So let's say you agreed with me instead of agreeing with everybody that's an energy bear and just believing that this is temporary and not necessarily anything, right? So let's just, because y'all are here, assume that you're at least giving me the benefit of the doubt, at least for this discussion. Then, as we've always mentioned, the benefit of fundamentals isn't that it would move there tomorrow. It's that you have some thought process and from an options perspective on direction and so both velocity as well as direction and the amount of the move. So what the energy bulls are saying is that they can't, until the supply comes on, the energy price will be whatever the market dictates, which is not, usually people are like, oh, the market will kind of stop here. But because the supply is so tight, I haven't heard anyone suggest a price of what it should be. And then some folks, the energy bears are saying, no, GDP is going to come to a grinding halt, and that's going to make all energy prices decline dramatically. And I think as that plays out, tough to say. I definitely think I'm on the bull camp. I'm not going to pretend, and clearly I've voiced that. Yeah,
I'm with you because there's so many products that use oil and gas.
Yeah, I mean, on the oil side, it's all of the chemical complex as well, pretty much. It's not great. Yeah.
Okay. Yeah, and then of course there are the airlines, which are obviously impacted significantly. And then obviously Boeing downstream from that. So it's an interesting time to be in the market if you're an options trader.
Yeah. And, the other thing I would mention besides the planes is really the cruise ships. I did lighten up on the rally. I'll probably come back in. Now, even more than the airplanes, the cruise ships to me are probably going to suffer the most. And there's three reasons that I'll go back through, even though I know you were here the other day when I was talking about it. The first reason is that the cruise ships are all offshore companies. So they really can't take any kind of aid, so to speak, from anyone. If you're Bermuda based, you're not getting US money if you have an issue with your industry. So there's that, number one. Number two is that they don't just have a rising fuel cost. They actually have a rising food cost as well. Remember and recall that a lot of the ships are based in the Mediterranean. And well, actually, let me clarify one more and say that a little differently. A lot of the ships would be in the Caribbean right now, and they would be in parts of Latin America where cruises happen because they do this relocation thing from Europe down to that area. They would also relocate to Asia down to Singapore, but because of what's going on there, most of the ships were not going to Singapore. They were coming across this way. What I would mention there is that they all tend to move back in the months of May, sometimes as early as late April. If the conflict persists aggressively, let me see if I can share my screen. You got the Bosphorus, and you've got that one little tiny avenue at the Straits of Gibraltar to get boats in. And again, you know, it really is the U.S. military that supports most of this earth, including Europe. So if you were going to try to move, troops using or support that region militarily using any kind of navy, you're going to have to. And the navy you would use is probably ours. This is why I'm always not a fan of war, because unfortunately, the USA has been footing the bill for a lot of different countries. Okay, you would have to bring them in through here. So America's got ships over in the south part of Spain, but the next navy that would make sense to go over would be the ones that are here on the East Coast, and they would have to come across here at the Straits of Gibraltar, right at the entrance to the Mediterranean, and then come in through here to the Straits, to the Bosphorus, here at the connection to Turkey and Bulgaria. There's probably World War II buffs that could explain this even better than I could, in order to get to the Black Sea. Now, the only other entrance into the Black Sea is down this way, and this is why cruise ships go over to Singapore. They come in through here, blah, blah, blah. So those would be your two entries into the Black Sea. And this is also happens to be how a lot of the cruise ships make their money, is they have these beautiful, wonderful, glamorous cruises on the Mediterranean starting in May, going all through the summer. Black Sea, a little bit less so. And as I mentioned, the cruises, largely speaking, have been canceled for the Baltic Sea. Some have done modifications where it doesn't go so close to St. Petersburg. But I mean, when I go to the cruise line industry website, it's really just this that's been modified. I haven't seen anything about the Black Sea. And in fairness, it's a smaller market, the Black Sea, nor have I seen yet anything for the Mediterranean. So these are all at risk. Additionally, while they could source some of their oil from Africa, you still have this massively aggressive price of oil. And it turns out we are the low cost producer in the United States. So, you know, we're going to be cheaper than if you bought your oil over here, but that is what it is. These guys hedge, of course, but come on, this point, you can't hedge a price that moves that much. You know what I'm saying? I mean, you can, but it's still painful if you're going to go through the summer. Additionally, you got to get food from this region. And like I said, we're going to have a problem with food in this region. So all of that, to me, is a lot of risk for cruise liners, given that their debt comes due in 2023. They pushed it out already 2 years. They haven't really made any revenue. Anyways, what I'm saying is that relative to airplanes, cruises are definitely, cruise liners look way worse. I would even, if you wanted, I could see if someone was even pairing them off, but quite frankly, I'd be short them all.
So with that, that there are different cruise lines that are impacted more so than others?
Oh, yes, definitely. Royal Caribbean actually got rid of Pullman Tour, which was its big Spanish cruise ship. I've been on Pullman Tour. It's a wonderful cruise ship to be on. So that's a little sad to me. But Royal Caribbean, in fairness, really only has 2 European branded ships. Now, that doesn't mean they couldn't put a cruise ship in there and try to make some money, which is absolutely what cruise ships do. That is the nature of that business. Carnival Cruise Line does have 23 boats out of 50 still, I believe. I mean, showed 23 boats out of 50. Let me say it that way, because there is some uniqueness all around. That is because they still own AIDA. Hopefully I'm not pronouncing that in the incorrect way, because that is AIDA, which we would pronounce that way in US, but it is a German branded cruise liner. And then the other cruise ship that is European branded would be Costa, which is an Italian cruise ship branded company. Now, Costa for sure, and AIDA, they're definitely hanging out probably in Brazil right now, is where they usually send those boats. They take them right on through from, Malaga or Lisbon on down. So I can't imagine that there's a ton of those ships right now in the Mediterranean, but that's where they would, historically have taken those ships. Now, what the cruise liners are going to do is difficult to say. And I like to short them ever so slightly better from a fundamental perspective, from a technical perspective, and from a how it's going to go perspective is another different story. But from a fundamental perspective, their story is far worse than that of the airlines. And that really has to do with the fact that domestic travel, largely speaking, in North and South America will probably be untouched. Among the airlines, if you were to ask me the same question, Delta, even though it does have a cute little refiner attached to the East Coast and close to JFK, did actually state as a part of the strategy it was trying to take that it would be looking forward to taking advantage of this period to build out further its transatlantic flights. So that ain't great, but yeah, hopefully that
short Delta
wasn't
so.
TMI for a very short question.
No, it's good. Yeah, Delta is the one that I'm short, because I understand that they did not make the proper arrangements for fuel and futures.
Yeah, I mean, in fairness, I don't know if that's so much the case. They actually typically do better on fuel because of the refining piece that they own. And you can see sometimes when you look through their, like sometimes you'll see if you just go to the revenue line, there's a revenue line called other, and then you have to go through farther into the notes and you'll see how much of that came from refining, which is typically all of it. You know, some of it's freight, but freight is separated as a different line item. Sorry, it's never freight because freight is separated as a separate line item.
Okay, thank you.
No problem. Any other questions?
May, one last thing, the yield curve. I just cannot, with full employment, right?
Yeah.
And interest rates low, and the economy pretty strong. I just don't see this causing a recession.
Yeah, it's really interesting because we've talked about the fact that the U.S. in many ways, oddly enough, is a net winner in this. Given the disruption to continental Europe and especially rising oil prices, and that continental Europe really isn't an oil producer, energy really affects everything. It affects transportation. It affects any kind of machinery. The autos business is probably going to be the autos manufacturing business is probably going to be disrupted in Europe. It seems to me that there are a lot of industries that really do benefit in the United States. I agree with that. I don't know if that answers your question.
Yeah. It's just, this yield curve is, it's so flat, but again, we talked about the foreign demand for our longer dated securities.
Yeah.
Which pushes rates down. Okay.
Yeah, it's interesting because when I listen to folks be so bullish on Europe, I'm not sure how they feel that way. Now, some of them have mentioned it's because the investment going to Europe to rebuild and all this stuff is going to be fantastic. And I'm like, you realize Germany came out and announced that it's got to spend that 5% that it hasn't been spending of GDP. It's got to spend that on military equipment. And there's only 2 countries that make military equipment that it's going to buy from. That would probably be France, but really the French market cap and amount of, look, it's really the US, okay? We have the top 5 largest market cap military companies in the globe. The other producers of military equipment, technically, but their governmental they don't really show up as market cap, so to speak, would be China and Russia. And I can't see Europe buying weapons or military equipment from those 2 nations, nor can I see those 2 nations selling it in that particular way. So I really don't like this direction that the world is headed in, but it is the thing. Anyway, that additional spend is not insignificant for GDP, because this is a flat out number of percentage of GDP. The spend for France and Germany right now is about 50 billion. The spend for the United States usually clocks in above 700 billion. And then so on and so forth, all the way down. And I just don't know how you as a country don't spend on military after what has just transpired,
Yeah, that's a great point.
Well, just a quick note, Devon Energy was recently upgraded by Zacks to strong buy. And apparently that news is sending the stock higher. So
yeah, Devon really got hit for a period of time, and it's just really crushed it. They are buying back I think they've said that they're going to give back in dividends $1.3 billion, and then they are going to buy back a little bit under a half like 550-ish million dollars worth of shares. That was before this conflict broke out, because they reported earnings, I think, early February. And they weren't sure at that point because it was unclear what was going on. The lack of clarity at that point. Very few companies reported at that point that they were going to increase production because they were really worried about the back end of the curve. It's not me saying it; it's all these other executives. The only company that did anything in the direction of making you feel like they were going to produce reserves fairly quickly is EOG. EOG is not buying back shares. So I think some of the investors got a little upset. They did give back a $1 special dividend. But what EOG did that I think was strategically very brilliant, whether or not the investment community is going to give them credit for it, is they went ahead and proved out their reserves at $40. You know what I mean? And as we've mentioned before, for just in case you're tuning in new, the US is the low-cost provider of oil and gas. They quote that most of the companies that are American do make money with oil price of $50, 55 now, let's see, because there's inflation. The many countries, Russia notwithstanding, is closer to 60. So, and then a lot of the Middle East, other than Saudi Arabia, is going to be somewhere in the mid 40s, so on and so forth. Any other questions?
It looks like the algorithm just bought Ford. So if you could,
oh my goodness.
Yeah, fundamentally, if you could stick that in your pipe, I'd appreciate it.
Okay, I mean, the car companies, I think, should be traded right now more like a day trader would trade them, because it's really a mixed bag. Because although auto demand is really fantastic, right, unbelievable, you still have the semi issue, and that's not insignificant. And you remember, of course, what our wonderful guest on Friday mentioned as far as some of these autos companies go. So I'll take another closer look just to see, maybe for another episode to talk about. Thanks for letting me know.
If you start following it, it would help.
Yeah, for sure. Any other questions or comments? Okay, cool. Now I wanted to mention, I'll have a very good friend on tomorrow, Henry. He used to work at BMO Capital. Really smart guy that covered business services at the time. He subsequently retired and just kind of hanging out, chilling, making money in the markets wherever he can, that sort of thing. So he's going to come in tomorrow and talk to us a bit. I'm very excited for that. So I will go ahead and close out the recording. Thanks, you guys. Good luck in the markets.
Thank you.
Bye.
Thank you, May.